Tony here. Welcome to the KIS Investing Weekend Review. As you can imagine, this is not the same market we've had since the summer. Things have changed, and we're going to take a deep, nice, quick look at it and see what we should do, what positions we should take, and also how we can protect ourselves in case the market has a tantrum. And we're going to also take a look at VIX, especially VXN, the VIX of the Nasdaq, which a lot of people don't look at, and it's telling us something. And I want to tell you what I think it's telling us. So, without further ado, let's get to it. Let's start by taking a look at the chart of the S&P 500 index. And let's take a quick look to see what has happened this year. So we started here in January around 3250 or so, 3230. And then we had a huge ramp up all the way to about 3,400, almost 3,400 on the S&P. And then we had COVID. Look at this down move, tremendous down move. And then look what has happened since. With all the money that the Fed has been printing, the market has been up and away. But let me show you why I think this market has changed. Let's take a closer look. So here we are. These two lines, the light blue line and the red blue line, are the 5-day and the 10-day exponential moving average. These are momentum averages. And the white line is the 150-day moving average, which I also like to tell me where the trend is going. Right now, clearly, the white line is pointing up, which means we are definitely on an up move. But let's take a look where these lines intersect. So here, around July 1st, the indicator that I follow crossed over to the bullish side. And take a look at this. Is unbelievable. Since July 1st, the green line has stayed above the red line every time. Even in this down move around the 26th or 27th of July, the red line did not cross over. And it stayed up, all the way until September the 2nd. That 2 whole months of pure upside momentum, crazy upside momentum. But take a look at what has happened since. We crossed over here around September 4th, and we have never seen 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 straight days where the green line is below the red line. Wow, this is a change of character. Forget it. This is not looking good. Now, should the bulls be worried? No, unless we break 3170, then I would start getting worried. And if I'm getting worried, I'm sure Uncle Jerome, Steven Mnuchin, everybody at the Fed and the Treasury will start buying stocks. Yes, they will buy stocks to prevent the market down before the election. Let's take a look now at the Nasdaq. Wow, very similar pattern to the S&P 500. Look at this. I'm not a candlestick person, but this looks like a gravestone doji or a hammer, and it's a very bearish reversal, and we're still below here in the momentum indicator. On the Qs, I wouldn't be worried until 246 on the QQQ price. And now here is why I think things are very different. People always look at the VIX, and of course we can remember this huge spike on the VIX, and then once again here at the beginning of September we had a very big spike that took VIX all the way to 38 here on September the 4th. And it has been stubbornly high. Doesn't want to break below 25. And this is a little worrisome. But if you really want to get worried, let's take a look at VXN. What is VXN? VXN is the volatility of the Nasdaq. And just take a look at what has happened since about the 19th of August, where we hit a volatility of 26, which is still historically very high. And now the Nasdaq vol is staying high, 36. At these elevated VIX levels, actually the Nasdaq is not really investable, and it's trending up. And if we keep looking and watching the Nasdaq volatility keep going up, I would urge you to take profits on the big winners you've all had on the FAANG stocks, and maybe not short yet, but please don't be in a hurry to buy the F&D dip, because this could be something a little more dangerous than we're looking at. Of course, if VXN starts trending down again, then you can once again establish your long Nasdaq and technology position. Very well. Now let's take a look at what the indices have done this week, and what are they telling? Let's start by looking at this very interesting post from Charlie Bilello, a guy I like to follow on Twitter, and it's telling us that in the month of August, the Nasdaq had a ridiculous 11% up move, and now it has had the same exact down move for the month of September. That means all the gains in August, which I think were fake gains, have already been eliminated from the market. Now let's take a look at the 10-year treasury yield. What would you do if you were able to buy treasuries at 11% or 10% in the 1980s? You would have been minting money. And even back in 2000, when we had a big crash in the stock market, the interest rates were around 6%. Unfortunately, right now, interest rates are ridiculous. They are below 1%, and like the Fed said over on Wednesday, they expect to keep rates low all the way through 2023, 24, 25, forever. But what the Fed knows, and it doesn't want you to know, is that actually the Fed can control the front end of the curve, but they can't control the long end. That means if the markets start pushing yields up because they see inflation, they see recovery, the Fed will have no choice but to raise interest rates and match what the market is already telling them. Now, the month of September has historically been a bad month for stock. It's historically the worst month for stock. Let's take a look at this seasonality chart from the S&P, and where we can see that the month of September is actually very bad month for the stock market. And most interestingly, the first half of the month is not as bad as the second half of the month. And this month we have already had a good down move. Imagine if we really have a bad second half of September. A lot of people are going to be scared, very scared. Now let's take a look what happened the last 5 days. This is also very interesting. The worst index for the year, has been the Russell. It was up 3%. And people on TV like to say, oh, it's the rotation. It's a healthy rotation from technology to the small caps. Let me tell you something. The small caps are the worst position you can have in your portfolio right now. These people that are buying up Russell right now, I don't know what they're smoking, but it's not going to end well. And the Dow had a flat week. The S&P was down 0.5%, which is nothing. And the Nasdaq, which has been the strongest indices, had a 1.2% down move this week. Now let's take a look at the year. As you can remember, just a few weeks back, the Nasdaq was up 40% for the year. Yeah, 40%. Now it's only up 25% for the year. The S&P is up 3%. The Dow is down 3%. And the Russell, which was up almost 3% this week, is now down only 6.8% for the year. These are very interesting charts. People say that people are rotating out of the Nasdaq into the Russell. Let's see. I really don't believe it. Take a look at the FAANG stocks every week. We see something interesting. For the third week in a row, yes sir, we've had red on the FAANGs. And the only stock that didn't want to join the red party was Tesla. Take a look at this. Tesla was up 19%. Tesla is the most overvalued company in the history of companies. Well, maybe Snowflake is the most overvalued right now, but Tesla, this is absolutely ridiculous. Today the market was down and Tesla was up 5%. I really don't know who's pushing this stock up, but I know they're very scared to let Tesla go down because probably the whole market would go down with it. Now, I also like to take a look at what's happened inside the S&P 500. And here we can see that we had a clear rotation out of technology and communications, which have been the leaders of the year, into the dog. The dog's talking about energy, industrials, materials, and healthcare. And believe it or not, even the worst sector for me right now, which is the financial sector, and in my point of view, don't even try bottom fishing in financials yet. They're gonna be losing their shirts with the low interest rates. Don't worry, there's gonna be plenty of time for you to buy financials in the future. Just don't do it right now. This is not the time. You could be sitting on that money for a long, long time. Months, maybe 6 months or more. Who knows, maybe a year. So why put your money on a debt sector until we started seeing that it's starting to move up? Now let's take a look at my anti-bubble positions. And I want to note that I have added two new positions to the anti-bubble. We all know about the commodities, the real estate, the rare earths, etc. And I have added the long bond. Yep, a lot of people might think I'm crazy. I think interest rates, if we have another big down move, are going to go down even further. And that's why I'm liking more and more the extended duration bond ETF and the zero coupon bonds, which are, as you know, longer duration paper. And I think they could be a good safe place for a temporary hold on your money. And I still like gold, but I think if you have been gold long and the commodity sector, soybeans, wood, etc., we should not be greedy. You should take some profits on commodities, lighten up a little bit, and maybe put in some more money in bonds and longer duration bonds to protect yourself in case we have a big down move in the next 2 to 3 weeks. Thank you very much for watching this week in review video. I hope you enjoyed it, and I hope you noticed the strange things that are happening, like the Nasdaq volatility creeping up and the dollar also stopped going down. So good luck next week and be careful. And if you like the video, help me out with the YouTube algorithm and click like it. Please subscribe to the video and also click the little bell so you can be notified when I post a new video. And of course, if you like it, share it with somebody that you think might find it interesting. And remember, you gotta risk it to get the biscuit. Good luck trading, everyone. Bye-bye.